Over the last month, we've seen every single capital city in Australia go up in value. On top of this, the stock market's on a run. Gold, silver, and crypto are going absolutely ballistic, which, to be honest with you, according to Phil Anderson's 18.6-year real estate cycle, should be happening right on time. Now, I don't know about you guys, but for the first time in a couple of years, I'm finally starting to feel a little bit better as interest rates have come down again over the last month. Now, when we look at the monthly capital growth rates across Australia's capital cities, you can see that a number of markets are doing exceptionally well. Darwin is obviously kicking ass at the moment, thanks to all of those buyers agents out there speculating on that market. On top of this, Perth, Brisbane, and Adelaide are still doing extremely well, and Sydney and Canberra are creeping back up there as well. Now, based on SQM's research in their boom and bust report for 2025, the top markets, or the markets that we should continue to see growth in, are going to be the likes of Brisbane, Perth, and Darwin. Now, when we look at the annual capital growth rates across Australia's capital cities, we can see that Darwin, Brisbane, Perth, and Adelaide are by far the front runners at the moment. Now, what's interesting to look at in this chart, or when we look back on previous months, is that Darwin was actually in the red this time last year and is having an incredible recovery. On top of this, Perth and Adelaide have come back a bit, and Brisbane is starting to shine above those two markets, which is exactly what we expected running into this Olympic Games cycle. I was actually trying to buy a property in Brisbane for one of our clients a couple of weeks ago, and that property was online for $695K, which I thought was a little bit cheap, maybe $10,000 below market value at the time. Now, that particular property had over 170 inquiries in the first 3 days and 54 offers over the weekend, ultimately selling for $805,000. Now, if that sort of pressure or demand continues in the Brisbane market, then we should see phenomenal growth over the next 12 months up here. Now, when we look at the vacancy rates across Australia's capital cities, as you've heard me say many times, we like to see a vacancy rate below 2%, which means the market is chronically undersupplied from a rental perspective. Now, thanks to the Australian government's pro-immigration plan at the moment, with over 500,000 people making their way into Australia, we can see that there is nowhere near enough product for people to live in, which has resulted in vacancy rates in Sydney, Melbourne, and Canberra sitting below the 2% mark, with the likes of Brisbane, Perth, Adelaide, Darwin, and Hobart actually sitting below 1%, which means they are chronically undersupplied from a rental perspective at the moment. Now, according to an article that I was reading in the Australian Financial Review, in Queensland alone, we are short about 30 to 40,000 new dwellings per year at the moment. And according to the Australian Bureau of Statistics, most of this immigration is finding its way into the likes of Southeast Queensland, Sydney, or over 160,000 people a year finding their way into Melbourne. Now, obviously at the moment, there's a couple of really positive things that the Australian government is doing for investors, which is creating a new first home buyers grant, increasing the first home buyers grant threshold in almost every state in Australia, and lowering the tax rate. Now, all of this is aimed at helping first home buyers enter the marketplace, but what's generally happened over the last 30 years in Australia when they do this is it pushes the prices up in the bottom of the market, and people that are bought in the bottom of the market jump to the middle of the market, which pushes the middle up, and then those people in the middle jump to the top of the market, and ultimately it ends up pushing the entire Australian economy and market forward. Now, so much of the hype and conversations in the media over the next year are going to be around bubbles and busts, as well as affordability issues and affordability crisis in the country. But we have to understand the structure of the Australian economy and how much money the government is making from things like land tax, stamp duty, and capital gains tax from property. And no government wants to be the one in power that ultimately pops that bubble. Now, when we look at auction clearance rates across the country over the last month, they've been actually surprisingly strong in Sydney, Melbourne, Adelaide, and Canberra, and they are on the rise compared to previous months. Now, that's a result of a number of things, including coming into the spring season, many people moving on with their New Year's resolutions, and a lot of people, now that all of the public holidays are over, getting settled and back into the year. It's also a really good leading indicator of demand in a marketplace before prices begin to go up if they stay at these 75 to sort of 85% levels. Now, over the last month, consumer confidence is up less than 0.5%, despite gold, silver, crypto, property, and stocks going absolutely ballistic. As Australians, we still feel almost as bad as we did in COVID and the last GFC right now. But regardless of how we're feeling, it is very, very clear to see that the data is heading and the property prices are heading in a different direction at the moment. Now, just because people are feeling good because rates are coming down down, and it's taking a little bit of pressure off households like mine, where I've been paying hundreds of thousands of dollars a year in interest over the last 5 years. It doesn't mean that we should recklessly go running into the marketplaces that are doing the best right now, and we should be very aware of which marketplaces in Australia are currently overvalued, well valued and undervalued, which I'll get to later in this update. Now, when we look at unemployment rates across the country, they are still ridiculously low, sitting at only 4.2% right now, which is about as close to full employment as we ever get in this country. Now, this is well below the averages between 1978 and 2024 that sat more around about that 6.62% mark. Now, when we look at the split between who's buying the property in the country at the moment, we can still see that mums and dads are 62% of the market, while investors are sitting well below that at 38%. But that scenario has actually adjusted in the last few months as more investors come in to speculate with prices going up in so many of Australia's markets at the same time. Now, based on previous long-term real estate cycles, as we move closer to the top of this market or this 18.6 year cycle, we'd see more and more investors that are feeling FOMO and that have missed out on some of the gains across the country in the last 5 or 10 years come rushing into the market to take us over the top at the very end. Now, in terms of interest rates, which is absolutely music to my ears at the moment, the Reserve Bank of Australia dropped the interest rates again over the last month, which has given you as a homeowner or an investor a great opportunity to give your bank a call and save yourself some bucks, and to make sure that they're passing on those discounts that we're seeing as investors and homeowners across the country over the last 6 to 9 months. Now, what I've found out from talking to literally hundreds of clients over the last couple of months is the rates are all over the shop at the moment, even with the same banks. For example, I've seen some investors or homeowners with the big 4 banks in Australia, and the difference between 2 people that are in exactly the same financial positions could be between 1 to 2% difference in their actual rates with the same bank right now. Now, one of the tactics that the banks use during these periods where rates are going up and down over a relatively short period of time is not always passing on these rate cuts or the full rate cuts to all of the people within their bank, hoping that so many of them will just sit there like I have been at the moment and not giving them a call to change things up or to ask them to sharpen their rates. While the 1% rate cut might not feel like a big deal, if you're sitting on $1 million of debt right now, that is over $10,000 per year, or $200 per week of savings that you can get for your family just by talking to your broker or to your bank at the moment. Now, when we look at the total number of listings across Australia over the last month, they're actually down a little bit, which is completely normal at this winter, slower stage of the year. As we move into the spring selling season, we should start to see, as always, a positive rise in listings as people get ready to move and to move on their properties. Now, what's interesting to me is all of that noise that we heard a couple of years ago about the mortgage rate cliff in Australia and all of these distressed listings that were going to come onto the market just hasn't eventuated. And I think as investors, we're getting better and better at discerning what is noise to sell advertising space and what's going on with the true numbers in the property market on a month-to-month basis. Now, when we look at the number of properties that sold under distressed conditions in the last month, from one month to the next, it was actually down by over 5.5%. Now, when we do the same thing year on year, according to SQM research, distressed listings from this time last year are now down by over 15.4%, which is probably due to a number of factors. One being the high number of new people coming into the country with great incomes. Another one being the fact that interest rates are on the way down. Another one being the fact that obviously incomes over the last couple of years for many, many people in many industries in Australia have gone up. But I think more than anything, it speaks to the resilience of investors and homeowners like yourself and myself really digging in there, going through a super hard time cash flow wise, and now we're hopefully coming out the end of that, at least for the next 18 months to 2 years. Now, recently I was able to put together with a friend of mine some incredible information on the Australian property market. What that enabled me to do in real time was look at the 19 largest property markets in Australia, and within those 19 markets, look at over 4,000 individual suburbs across over 60,000 key performance indicators. Now, what that's enabled me to do outside of sleep so much better at night is look at Australia from a much different and much larger context. And what I've found is that for me personally, the 2 markets that I see the most value in for me as an investor over the next 7 to 15 years. And number one, the Brisbane market leading into the 2032 Olympic Games, and obviously the Melbourne market, which is at the bottom of its 8-year cycle right now. Now, the reason that I like Brisbane is there's obviously publications like the Australian Financial Review coming out saying that the average $800,000 property last year could be worth as much as $1.2 to even $1.4 million by the Olympic Games. On top of this, when we look back at history and we look at what happened in Sydney between 1997 and 2003, we saw prices in Sydney during that time go up over 97% and rents almost double. Now, the reason I like the Melbourne market, even though it is the worst performing market in Australia over the last month and the last 12 months at the moment, is the fact that it is sitting at the bottom of an 8-year low. Now, I'm not joking. I'm speaking to at least 30 investors every single week right now, and most of them are completely writing off that market, saying things like so many people left during COVID, the Victorian government basically imprisoned the population down there, and the local economy and the state economy is completely shot. Now, I remember when I was buying in Sydney in 2011, because at that point, Sydney had done less than 1% per annum for the 9 years leading up to that point. People were saying the exact same things down there. I also remember when I started to buy Brisbane and the Sunshine Coast in 2013 through to 2017, the average person was saying, why would I look at that market? Sydney and Melbourne are absolutely cranking right now. And the reason I was looking at it that time was because it had done, again, less than 1% per annum for the 10 years leading up to that point. Now, when I look at Melbourne at the moment, according to CoreLogic, the average difference between the Sydney market over the last 30 years and the Melbourne market has been about a 29% difference, with Sydney always leading the way. Now, what's interesting right now is that there's about a 60 to 65% difference between those two markets, which is the largest gap that we've seen between those two cities in the last 30 years, and one of the largest gaps between the two cities in the last 200 years of Australia's history. Now, according to SQM, Melbourne's going to be a bit of a slower burn there, and there are going to be markets like Darwin, like Brisbane, potentially like Perth and Adelaide that smash the performance of it over the short term. But if you're looking for value, there are literally properties available for sale in that market at the moment for as low as $550,000, which I believe is a phenomenal opportunity to at least start learning about that market, as well as the shiny Brisbane market leading into the Olympic Games. G'day guys, my name's Ben and I'm the director here at Pumped on Property, and I just want to say a massive thank you for watching our content today. Now, if you're thinking about buying an investment property in the next 3 to 12 months, then the team and I would love to offer you a one-on-one strategy session. In that session, we can talk about exactly where you are right now, where you'd like to be longer term, and we can deeply educate you on the Australian market. And then you can take that information and go and absolutely smash it on your own, or potentially become one of the small number of clients that we work with each week. To book your session, all you have to do is go to www.pumpedonproperty.com and click that book your free strategy session button. But either way, we wish you all the best on your journey as an investor to financial freedom.